Okay, so we're up to class 25, getting close to Thanksgiving and the end of the class. We have a few more topics. We're going to continue on this topic of valuing stocks, but here we're not going to really value them as much as we're going to compare their value to other stocks. Relative value analysis is a very, very important part of finance, obviously. You hear a lot about this, PE ratios, price to book ratios. So let's get into that and what it means. And there's some really foundational issues here we're going to cover. We talked about this a little earlier on the first exam. You talked about growth versus value stocks. And we usually use relative value analysis to figure out what's a growth stock, what's a value stock. So some really fundamental things here, but it does tie back to valuation. You'll actually see at one spot, we'll stop and look back at the formulas we've already used and get a good understanding of exactly what relative value tells us about how stocks perform in different environments. So this is an entire presentation just on relative value analysis. It's an extremely important topic. So it's one of three common investment approaches. We've already seen one. This is the second one we're going to cover. And then the third one we won't cover in this class. I do cover in another class, and there are some classes at UTSA that cover the third approach. We're then going to ask, what is relative value analysis? But relative value analysis is usually a little more comfortable, common sense in the real estate world. We tend to think relative value in real estate world quite naturally. So we'll establish exactly what we're doing with relative value analysis by looking at something that we're more comfortable with real estate, and then we'll apply it to the stocks. We'll talk about what's a good component of a good, what are the components of a good relative value analysis. This is essentially what I'm going to be asking on the exam, is making sure you understand when is a ratio the right ratio and when is it not the appropriate ratio. And we'll look at some common price relatives. We'll put some industry linkages in there, and I'll show you how we actually use this in practice, and there's really quite a bit of application here. So what are those three approaches that we have for investing? Well, and it can be either on the asset strategy side. Remember on the first exam we asked, are we going to be strategic or tactical? So the asset strategy side, we can use these approaches to try to figure out if small caps are expensive or large cap are expensive. Where do you want to invest? Do we want to invest overseas? Do we want to buy bonds? So asset strategy, and then security analysis. Do we want to buy Google, or do we want to buy Walmart, or do we want to buy Apple or Facebook? So either at the asset strategy or security analysis side, these three approaches all work. The first one is fundamental analysis. We've already covered that one earlier, but fundamental analysis is essentially what we did in class with all the valuation models, the dividend discount model, and what you'll be doing fundamental analysis on papers 3 and 4. And that's really just sitting down and trying to figure out the value of a stock by taking the present value of its future cash flows. Technical analysis we will not cover in this class. I do cover it in my security analysis class, but real quickly. And we do have, UTSA does have a technical analysis class the entire semester. It's not offered very often, but when it's offered, I'd encourage you to take it because it's good to have those skills, but we won't touch that. We talked technical analysis earlier in the semester. It really is using price behavior, price patterns to try to predict where prices are going next. And there's some really good books. I think I might have given you some books that you could read. One by Dr. Andrew Lowe that I really like. One by Dr. Dahlquist, a former professor at UTSA. So there's some good books if you're interested in that. Even more than that, there's a lot of really interesting websites. So if you want to go that approach, there's a lot of debate whether or not it really works or not, but you could certainly become more adept at that and teach yourself a lot of that. But the last one is one we want to focus on today, and that's relative value analysis. It's used both for asset strategy and security analysis. I've used it for both. It works well for both. And essentially, just in a nutshell, what is relative value analysis? It's comparing some current measure of value of an asset or security to its underlying fundamental factor. So the value might be the price of the asset, we'll compare that to maybe the earnings of the asset. So that's where we talk about price to earnings. The price is the measure of value. Earnings is the fundamental factor. So what we want to do is figure out, what is this price that we're paying? How does it line up with what we're getting from the asset? Are we paying too much or paying too little? So there are two measures of value we're going to talk about: price and enterprise value. So price is what you look up on Yahoo Finance. It's the actual price of the stock. Enterprise value is essentially the value of the company to both the stockholders and the bondholders. It's essentially the stock value of the company plus its total debt. So those are the two measures of value we'll be using: price and enterprise value. And then the fundamental factors can be just anything, any measure that all assets being assessed have relatively available. We're going to talk the most common ones, which are earnings, revenue, and book value. Book value is just the net worth of the firm. It's assets minus liability. So those are the most common. But there are several industry-specific ones. I'll maybe give you a few examples of those where you're more precise and looking at a specific industry. You might use something more related to maybe it's revenue per, or maybe it's price to regulatory assets if you're doing a utility. It kind of depends on what factors you have out there. I've actually used price to employee, or really market value of the firm to employee, just to show how amazing Facebook is and the tremendous value per employee. Just doesn't have that many employees, but is an extremely valuable firm. So relative value is not actually valuing the asset. It accepts that all assets are probably well valued because markets are efficient. So what relative value is asking is, how does this asset look, expensive or cheap, relative to other similar assets? And we use these terms, and again, remember, I've been picky on the terminology. Remember when we did duration, we said, when we did spreads, we talked about spreads narrowing or widening. We didn't talk about them going up or going down. So narrow and wide are the terms you use for spreads. Well, for stock valuation, we use the terms cheap and rich. And I'm not sure I like these terms. Cheap is actually a good thing. It means the stock is inexpensive. It doesn't mean cheap as far as low quality. It just means it's inexpensive. And rich means the stock is expensive. If you think back to value and growth, we talk about value stocks, growth stocks. Value stocks are cheap stocks. They may actually be low quality, but they're cheap stocks. And then growth stocks are rich. They're stocks that look expensive because they have something going for them that the market really likes. So let's use a real estate example. And I think you just intuitively will have no trouble following this example. And then the key will be to link it then to talk about stocks. So let's start with just very little information. You're looking to buy a house. All you get is the price of the house. The house costs $150,000. Would you buy it just based on that without looking at it, not knowing what neighborhood it is? Well, maybe you know the neighborhood. So you know the neighborhood, maybe that gives you some sense, but probably not much. $150,000 without seeing the house or knowing anything about it, yeah, you're not going to buy that house. Well, then you get some other information. You find out that in that same neighborhood, 2 other houses have sold recently. One sold for $875,000 and one sold for $675,000. So now do you buy the house? Well, now it's getting a little more interesting. You say, well, this house is really inexpensive, but maybe it's inexpensive because it's crumbling, or maybe it's on a land a plot of land that's sliding away, going down a hill. Some of the mudslides you see in California. So what's going on with this house that it's so cheap? So now you're interested because it's really cheap, but you have to ask, why is this house going for so cheap? Obviously there has to be a reason, or someone would have bought it by now. Well, the next thing you do is they tell you the price per square foot. And they say this house is trading for $75 per square foot. And those recently sold houses were trading for $250 and $225. Well, now at least you've adjusted the value of this real estate for the size of the house. And now, it's starting to look really, really interesting. $75 when other houses in the area are going for $250 and $225 per square foot. Boy, this looks interesting. Well, price per square foot is a price relative. It is a relative valuation. So price is your measure of value, what the house is worth. Square foot is that fundamental factor that tells you something about the underlying fundamentals of the house. So that is a price relative. Do you buy it now? Well, now you're thinking, okay, this is a cheap house, but why is it cheap? What else could we look at? And that's when we really broaden it out. And let's say we pull in any, and there's probably other things. And I'm not saying this is the right list. I'm not a real estate person, especially not a residential real estate person. So add any other factors you want. I just off the top of my head came up with some. So the size, we've already adjusted for the size by doing the price per square foot. Does it have a pool? How many bedrooms? How new is the kitchen? How big is it? How nice is it? Landscaping. When was it last painted? Although that wouldn't cost you that much. Age of construction. How old is the house? How old are the floors? The roof. Do you want to spend $6,000 to $7,000 fixing the roof? You want to spend a couple of $1,000s fixing the fence? How large is the garage? If you always park 2 cars in the garage and it's only a 1-car garage, that's going to be an issue. The quality of the schools you might want to look at, and obviously that's going to be the same for the other 2 houses since they're all in the same neighborhood, but you'd want to look at that. So those are measures of value. You also want to make sure you have measures of risk. You never want to make an assessment of the cheapness or richness of an asset without looking at both value and risk. If you leave risk out, what you end up with is buying stuff that looks cheap that's just actually very, very risky. So is this house in a floodplain? I was watching a video from Australia where this family got complete approval from the city to build their house. And then after they paid all this money and got started on it, then the city decided they were in a floodplain and they weren't allowed to build the house, and they'd already invested thousands of dollars. And now they can't build the house and they can't sell the land because they've just got designated as being in a floodplain. So those are important things. They can have huge implications on the value of your house. Is there any foundational issues? There are places I know people have up in Austin have foundational issues just because the land that they're on got so dry and it just caused the ground to crack, and now they have cracks in their house. How far away is the nearest fire department? Some people may not care about that. You know, fire is pretty rare, but some people it would. What's the neighborhood like? You may have seen some of those YouTube videos of the world's worst neighbor, and some of those people are pretty amazing, and they can definitely reduce the value of your house. There's a house selling where I ride my bike, and the guy across the street, he's very political, and he has these signs in his front yard. And I was going to ask him if, you know, when the neighbor passed away, so they're trying to sell the house, the heirs are trying to sell the house, and so they're doing all these open houses, and I felt like telling this guy, you know, would you be willing to take your political signs down, because they're pretty aggressive signs? Would you be willing to take them down when they're having an open house across the street, just so the people moving in aren't worried about this neighbor? He's a really nice guy, so he'd be a great neighbor, but he has some pretty hilarious signs in his front yard. So that can impact the value of a house, but those are risk related. So let's say we take all those factors in, and we get an R-square of 91% explaining the prices of 350 homes sold in the last 3 years. Remember R-squared? That's what we use on exam 1. We talked about parsimony. You know, how many asset classes do you need? You need enough to get a high R-squared so you can explain the risk of the portfolio, but you don't want to overdo it. Well, here we want a high R-squared because we want to make sure our model is capturing everything people are looking at when they buy a house. Now, we might say some of the things in the list are not important to us, but they're still important to consider if we need to sell the house in the next 4 or 5 years, because those are the items other people buying the house will be looking at. So we got, using all of those statistics and what other statistics you can think of, we got an R-squared of 91%. We can explain 91% of the variation in prices of 350 homes sold in the last 3 years. And when we do that, we get that the house should be trading for $150 per square foot, but we can buy it for $75 per square foot. Now you're getting really interested. This price is half price. Now you're still asking, why is it so cheap? Can I go look at it? What's going on? So, but now you might buy this house blind now without looking at it. Obviously, not many people are going to buy a house without looking at it at all. But at this point, if they just not allowed legally to look at the house, and you put everything in that you can think in that list, including just the quality of the house, how aesthetic it is, anything you can think of. Some of those are pretty subjective. And based on that model, the house should be going for 150. You're still a little worried, but you might do the trade. And that's essentially what we're doing with stocks when we do relative value analysis. We're getting what we think the value should be given based on how the market typically values stocks. And then we look at what it's actually trading for, and we just found a cheap stock. Now, what if we can increase the R-squared by asking 2 more questions? Has anyone ever been murdered in the house, and is the house considered to be haunted? Now, when you do that, you hope that your valuation stays at $150, but it doesn't. When you make those 2 adjustments, the value of the house falls from $150 to $80 per square foot. So now you know something horrible has happened in the house. It's still cheap. It's worth 80 bucks, and you can buy it for 75. It's still cheap, but it's not as compelling, and you know something really horrible has happened in the house. Now, the question to ask is, what if you don't care? What if you're not superstitious? You don't think houses are haunted? You don't care that someone's been murdered there as long as they clean everything up. I remember watching one of those hidden camera TV shows where they were showing a house and they actually had a chalk drawing of a body on the living room floor as they were showing the house. This is a joke, and people would ask, wait, what's all this? And the real estate agents, oh, we're going to clean that up, don't worry about it. But they're like, wait, what's going on here? So that's make people a little bit nervous. Does it say something about the neighborhood and those kind of things? But let's say you don't care. So if you don't care, that means the value of this house, everything else you have in your model you care about. And based on that, the house is worth $150 per square foot. But because there's been a murder in it, people think it's haunted, you can get the house for 80 bucks a square foot. And you don't care about those things. So now do you buy it? Now you found out why it's trading so cheap. Do you buy it now? Well, if you're going to live in the house for 20 years or more, yeah, you probably jump at the opportunity. You're getting a really good deal. You're getting $150 per square foot house for $75. And you're going to live in it for 20 years. You're getting, boy, a 50% discount there. But if you need to sell the house in the next few years, maybe not. You're paying 75 and it's worth 80, but the fact that something horrible has happened in the next 2 or 3 years, people buying the house are going to find out that information, and you don't know how they will react to it. Maybe it dissipates over time, you don't know, but there's something there that's really bringing down the value of the house, and so that makes you a little nervous about buying this house because you know future buyers are going to have that issue. This is the exact same thing with stocks. You value it based on things you care about, and you don't get a high enough R-squared, maybe only about 80, 85%. So you add other things that you think the market might care about, but you don't care about, and now you get to an R-squared of 95, 96. So now you know what the market's looking at, and you say, I don't think the market should be looking at that. That doesn't look important to me. If that's the case, and the stock looks cheap, then you buy it. You just have to realize if you have to sell that stock in the next year or two, you're probably not going to, it's not going to be as valuable as you think because other investors are using those other items to value it. So real estate's a good way to get into this concept of relative value analysis. So relative value analysis, first of all, we're ignoring whether or not the housing market itself is overvalued. We don't ask wow, what's the value of a house? And that's really hard to do. You can do it. If you want to figure out the value of a house, you could look at a comparable apartment and look at the rent on that, and that's essentially what you're saving by buying the house and not having to pay rent, but then you have to pay property tax and other things. So you could actually come up with the value of the house based on cash flows because of the cash flows you save by not renting an apartment, having to stay in a house. If you do that, you're almost always going to find that real estate is not worth it. Buying a house is not worth it. You can almost never justify buying a house based on the savings you're getting from not renting an apartment. It's just really difficult. Unless you were to rent an apartment that was as large as the house. So if the house is 3,000 square feet, if you rent an apartment that's 3,000 square feet, yeah, there's a good chance maybe, it won't be overwhelming, but it's a good chance maybe that buying a house would be more valuable. But most people, if they rent an apartment, it's a smaller setup than buying a house, and so it's typically hard to justify buying a house based on that. So here we're going to use relative value, and most people do use relative value. So what we're asking is the price of the house I'm considering buying reasonable given what other houses are selling once I adjust for key differences in the houses? And that's the key. And it's the same thing with stocks. Is Microsoft a good stock to buy? Well, I'm going to compare it to Google. I'm going to compare it to Apple, to other companies, Oracle maybe, and just ask, given what I know about Microsoft, and I'm adjusting Microsoft for all of these numbers, what should it be trading for versus what is it trading for? And then I have a decision, do I buy this stock or not based on that? So what should be in your price relative? Well, you have your price relative itself. So whether that's price to earnings, price to book, enterprise value to sales, we'll talk about each one of those here in a little bit and understand when you use one. But you want to use the correct relative that is appropriate to your industry. We're going to talk about that as well. There's some relatives that are just wrong. You're dividing the wrong thing into the wrong thing. And there's some relatives that are more appropriate for one industry versus another. So there's two aspects here you've got to get. And then you got to make sure you're adjusting for key fundamentals and key risk factors. You'll do that with generic numbers, but the more specific you can get to your industry, the better your analysis is going to be. And I'll try to show you an example here at the end. But yeah, I mean, the more specific you can get, the better analysis, the higher your R-squared would be. And so I'll give you some examples of those. But that's what we're looking for. Your analysis needs three things: the right price relative, the right fundamentals, the right risk factors. You need all three of those, and I'll talk about how we'll use them actually when we're doing regression analysis. So all three must be available. So our goal is to use fundamental and risk factors as our independent variables to forecast what we think the relative value will be. That's our dependent variable. If you've done any type of multivariable analysis, it's essentially what we're doing. We do this a lot in investment societies. So if we can get back on campus in the spring, I'd encourage you to join one of the sector teams so that you can see exactly how we do it. It's a really good experience to have, and it's really easy to do in the Bloomberg lab and just bringing the data in. That's exactly what we do. We bring in a bunch of fundamentals. We bring in lots of risk factors. I'll show you one of these models here in a little bit. And by using all of that, we're trying to forecast what should their price relative be. And then we compare that to their actual price relative, and tells us whether or not we should buy the stock or not. Firms with really high fundamental values, like high growth, high earnings, high margins, that should be in higher relative values. You should have to pay more for those stocks. Firms with higher risk factors, such as higher debt, more volatile earnings, higher fixed costs, that should mean a lower relative value. Those stocks should be cheaper. So here's a key formula. And I want to stick on this formula. I would print this out and carry it in your wallet if I were you. This is so critically important. So hopefully you all recognize this. So the value of the stock is dividends divided by KE minus G. Do you remember that? That's the good old dividend discount model. I'm not making a distinction whether it's dividend 0 or dividend 1. But dividends divided by KE minus G. Well, what is KE? KE is the risk-free rate plus beta times the market risk premium. What are dividends? Where dividends are earnings per share times their payout ratio. If they're paying out 40% of their earnings in dividends, so if they make $2, they're going to pay out 80 cents in dividends. Now, if we take this formula here and we move EPS over to this side, so we divide both sides by EPS, we end up with price to earnings per share, or the PE ratio. And if you look at that, what are we left with? the payout ratio divided by the risk-free rate plus beta times the market risk premium times minus growth. There is a world of information in this formula. So if you look at PE ratios, what drives a PE ratio? Well, let's start with interest rates. Interest rates is in the denominator. If you reduce the denominator, you increase the PE ratio. What that means is when interest rates are low, PE ratios are high. When interest rates are high, PE ratios are low. And you can see that historically. It is absolutely the truth. In the early 80s, when we had really high interest rates, PE ratios were like 6 or 7. Really, 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 really low. Today, with really low interest rates, we're seeing PE ratios in the 22, 23, 24 range. Much, much higher PE ratio because interest rates are low. The second one, the market risk premium, you saw that in the video on paper 3 and 4. The market risk premium is how much do investors need to buy stocks in general, not your specific company that you're looking at, but stocks in general. So what we know, again, this is in the denominator, so if the risk premium increases, PE ratios will fall. If the risk premium falls, PE ratios will rise. So if the market's really worried about risk, you'll see PE ratios fall as the stock market gets cheaper. If people aren't worried about risk and the market risk premium is really low, then the stock market's going to look really expensive. That's one of my explanations for why the stock market looks so expensive right now versus history. As some people argue that the market risk premium is unusually low right now, just because the world has changed so much, information is so easy to get. It's become more global and more interconnected. And so I think you can make the argument that in normal times, the risk is much lower, but the crises may be much greater. So when we hit a risk bump, it's going to be a huge bump and really derail us. All right, so those are two items. If you think about it, the risk-free rate, use the same number for every stock. When you do paper 3, you're not coming up a risk-free rate for your particular company. You're coming up one for all stocks. If you're using a 10-year treasury, that's like 0.7, 0.8% or whatever it is today. You're going to use that for every stock you value. The same thing with the market risk premium. It applies to every single stock you value. So it doesn't matter what company you're looking at. These two have the exact same impact on every company. So those are generic relating to all stocks. We just know in general, stock markets look more expensive when interest rates are low and when the market's not worried about risk. Stock markets look cheap when interest rates are high and when the market risk premium is high. So what are we left with? Beta and growth. These are things that are specific to your company. One of them is a risk factor, which is beta, and one of them is a fundamental factor, which is how fast the company is growing. When the company is riskier, you increase beta, the PE ratio will be lower. When a company is low risk, the PE ratio will be higher. So high-risk companies have low PE ratios, all else equal. Low-risk companies like a Campbell's Soup or a Kroger store, they will have higher PE ratios just because they're lower risk. And the last factor, we're subtracting it. Since we're in the denominator and we're subtracting, the higher the growth rate, the higher the PE, because we're subtracting this in the denominator. The lower the growth, the lower the PE. And if you think about this, this gets back to value versus growth stocks. What do we say about value stocks? They're risky, they're low quality, they have a lot of debt, so they have high betas, and their fundamentals are terrible. They're growing really slowly. So what does that mean? They have high betas, they have low growth, so they have very, very low PE ratios. That's why they're value stocks. They're risky and they're slow growth. Growth companies tend to be higher quality. They could have higher betas, but they tend to have very, very high growth. Because they have high growth, and that's why we call them growth companies, they have high PE ratios. So you can see on one ratio, we can explain a lot about stock markets. It's pretty amazing. I do have charts and graphs that actually show PE ratios over time relative to interest rates and relative to inflation. And there is a very, very high correlation between interest rates and PE ratios. In fact, it's not a bad regression for you to run because when the stock market gets away from that relationship, that's usually a good time to avoid stocks. Right now, the stock market doesn't look particularly expensive. When you adjust it for the level of interest rates, it doesn't look cheap, but it doesn't look particularly expensive. But back in 2000 with the dot-com, bubble, yeah, stocks were way off the charts. They looked way too expensive relative to the level of interest rates. And so this can help keep you out of trouble buying stocks at the wrong time. But anyway, keep this formula right here. It's easy because it's just a dividend discount model adjusted by breaking out dividends between earnings per share and payout ratios. Now, the one thing I didn't talk about was the payout ratio. But if you remember, when we were talking about growth, one of the growth rates I gave you was sustainable growth, which is return on equity times retention. So finance has a theory that the more firms pay out, the less they can grow. If they don't reinvest in the firm, they can't grow fast. So you can essentially, from a theoretical standpoint, you can essentially ignore the payout, because the higher the payout, that should increase the PE ratio, but it's going to also reduce the growth. They offset each other mathematically. And so the payout ratio and the growth rate just offset each other. When one goes up, the other goes down. When one goes down, the other goes up. So those two are a wash, and so that's one you can essentially ignore. So let's look at some firms. I don't remember when I did this. It's been a couple of months. No, actually, this is much older. So this is I did this a few years ago because I thought it was really interesting. So Apple at the time I was looking at that was trading at a PE ratio of 11, and you have to ask, well, what are they trading at today? I'll see if I can pull that up while I'm talking. But so right now, Apple, obviously, they're much higher than 11 today because they've done so well. And so their actual PE ratio now is 35. So you probably wish you had bought Apple back when its PE ratio was 11. Google, when I did this, their PE ratio was 29. That looks really expensive. Or Alphabet, whatever you want to call them. Their PE ratio today is 33, 34. We know that Apple and Google are up a bunch in price. Apple's up the most. Back when I did this, Apple looked incredibly cheap, and so we bought Apple. It just made a lot of sense to buy Apple back then. They were so cheap. People were worried that Apple had hit its prime and just couldn't grow anymore, but they've done a good job with new releases of the iPhone and with Apple Watch and some other things. So they've somehow kept themselves relevant. Google keeps growing and is doing well, or Alphabet. Campbell's Soup, when I did this, was trading at 28. And today their PE ratio is 9. Now, why is that? We'll talk a little bit more about Campbell's Soup. And in Amazon, when I did this, they were trading at a ridiculous PE ratio of 295. Now their PE ratio is all the way down to 95, and that's not because their stock prices come down. It's because the earnings, remember, it's price over earnings. Amazon's earnings have increased dramatically. So their stock price has actually come up, and not nearly as much as their earnings. So they've gone from a 295 PE ratio to a 95. So there's an example. Let's think through each of these. So Apple's trading for 11. You have to pay $11 for $1 of earnings for Apple. Amazon, you have to pay $295 for $1 earnings at the time I did these ratios several years ago. So what is that telling us? Well, it could tell us that Apple's really cheap, which I think was the case. It could mean, remember the formula, if you go back to this formula, why are PE ratios low? We're talking about Apple in particular, so remember we're going to ignore the risk-free rate and the market risk premium because that applies to all stocks. But it could be that Apple's high risk, so they have a high beta, or they're low growth, they have a low growth, so one of those could be those. So they could be cheap, it's just a cheap stock. Could be a slow growth company, could be a high risk company, or some combination of them. I think the overwhelming answer at the time I did this was that they were cheap. What about Amazon? Well, they could just be really expensive, they could be rich, or they could be really high growth, or they could be low risk, or some combination. Well, I think what the world has shown is that they were just extremely high growth. Now, their PE ratio is still really, really high at 95, so the market's still assuming they're going to grow really fast. I think you could argue Amazon looks a little rich in some cases because, you look at their AWS and their Their cloud computing, that's a big part of their earnings. It's a major part of their earnings. Their retail side doesn't really grow earnings that much. And that business, while it's still growing, is not necessarily a high growth business, even though people are still converting to clouds, and there's a lot of competition there from other companies, including Google, so and Oracle and a lot of others. So yeah, it's, I'm not going to argue not to buy Amazon. That would always, you have to make up your own decision, your own mind. But what about Campbell Soup? Why was it trading so expensively back here? And for Campbell Soup, I'm going to argue that it's a very low risk stock. So the reason it had a high PE back there is because it had a very low beta. Now today, its beta has come down mainly because its earnings are so weak. It's that low growth, and so it's a low PE stock now just because even though it's low risk, so that should be a high PE ratio, their growth is so low, almost negative, that just gives them a real much lower. So this is Apple would have been a great one to buy. Campbell Soup would have been a great one to avoid. Google's kind of in the middle. I think Google is definitely in the high growth area, and their PE ratios actually come up even more. But it just shows you how you can see how we can just look at this ratio, this formula, and very quickly talk about what kind of stock do we have. And you can see how we can talk about Apple being a value stock at the time this was done, Campbell Soup being probably a more growthy stock. This is kind of tricky with value versus growth, but they're low risk, so they look expensive, so they probably would have been classified as a growth stock back here because their PE ratio was so high. Google and Amazon, obviously growth stocks, no question on that. So Apple, surprisingly, at the time I did pull these numbers, I'm glad I left them in here because it's amazing what's changed since then. Apple would have been a value stock, and I do remember a time when people were talking about Apple as a value stock. Pretty amazing. Today, it's a very different world. All right, so let's get to the actual ratios themselves. So we have numerators and we have denominators. Remember the numerators, that's our measure of value, and there's two choices there. The current price, that's stockholders only, and the current enterprise value. That's stockholders and bondholders. That's what enterprise value means. If you go on to Yahoo Finance and click under statistics, Yahoo Finance will actually give you the enterprise value for the firm. So right now Amazon is $1.5 trillion. That's their stock value is 1.5 trillion as well, so they don't have much debt. It is possible with some firms, I'm going to check Apple out, it is possible with some firms you'd almost always think that their market cap would be greater, or their stock value would be, your enterprise value would be greater than their market value because you're adding debt. But it is possible for the enterprise value to be lower because what they do with enterprise value is they take the stock value of the firm, they add debt, and they subtract cash. And because Apple and Google and Microsoft have so much cash, it's actually possible that that the enterprise value can be lower. But for Apple, it's slightly higher, but part of that's because they're not measuring Apple's cash correctly. They put the full value of Apple's cash in there, their enterprise value would be lower. So you got to choose one of these two, and we have to talk about which one do you choose, and I'll show you that here in a little bit. Your denominators, the most common are earnings, earnings per share, earnings for interest and taxes, earnings for interest, taxes, depreciation, amortization. Those are the three most common ones. There's one other one called the PEG ratio we'll talk a little bit about here. Book value, that's just the net worth of the firm, assets minus liabilities, and then revenue. So those are our three choices. So there's two questions we got to figure out. First of all, which numerator goes with which denominator? You can't just mix and match these randomly. You have to line them up correctly. So the second question to ask is, once you know which ratios work, which numerators go with which denominators, then you have to ask which ratio goes with which industry. So now we have to match it up to the correct industry. So let's start with that first question. It's extremely important that you match the capital provider in the numerator with with the correct value in the denominator. I'm going to go back to this previous slide and let's talk about it. Remember, stockholder only is price. Price is stockholders only. enterprise value of both stockholders and bondholders. So the key here is the denominator. You have to ask, is this denominator only belong to stockholders, or does it belong to both stockholders and bondholders? Earnings per share, that only belongs to stockholders. EBIT and EBITDA, you notice that it's before interest expense. Anything that's before interest expense, you use enterprise value because it belongs both to stockholders and bondholders. Students miss this so rarely on the final exam. I don't know why, because to me it's real straightforward. If it's something's before interest expense, make sure you use enterprise value. If it's after interest expense, make sure you use current price. To me, it's really, really straightforward. Book value is assets minus liabilities, so you're subtracting all the debt out. So book value belongs to the stockholders, so it's price to book value. You don't do enterprise value to book value, you do price to book value. And then revenue, if you think about revenue on the income statement, it's before interest expense. And so we don't do price to revenue, we do enterprise value to revenue. And so that gives you the combination. So we can do price to earnings, and we can do price to book value. We do enterprise value to EBIT, enterprise value to EBITDA, which is probably the most popular one, or enterprise value to revenue. Those are your choices. Price to earnings, price to book value, enterprise value to everything else if it's before interest expense, and all the rest of these just happen to be. Okay, so if the denominator is before interest expense, the numerator must be enterprise value. If the denominator is after interest expense, earnings per share, and book value, the numerator must be current price. Those are your only choices. Now, if you go into Yahoo Finance and look at key statistics, you'll notice that they have the PE ratio, they have a trailing and a forward PE ratio, they have the PEG ratio. Remember we talked about the PEG ratio before. The PEG ratio is the PE ratio divided by G. So the PEG ratio. They have enterprise value, they have price to book, they have enterprise value to revenue, and they have enterprise value to EBITDA, and then they have one that's incorrect. They actually show price to sales. You're not supposed to use price to sales because price is only stockholders, whereas sales or revenue, whichever way you want to call it, price to revenue. Revenue belongs to both the stockholders and bondholders because revenue is before the firm has paid interest expense. So Yahoo Finance actually has one error on their webpage where they show price to sales. And you'll see TTM next to some of these. That just means they're doing price over the previous 12 months, trailing 12 months. All right, so there's your choices. Price to earnings, EV to EBITDA, EV to EBIT, the PEG ratio, price to book. You can do price. I've seen some companies that their book values actually go negative because they bought so much stock back. So if you think about book value is essentially the firm's earnings since inception. It's the last 50, 100 years of earnings. So you could think of book value as being the accumulation of earnings, net of paying dividends out. So if your firm doesn't have a book value, what you could do is take price and do it as a factor to a denominator that has multiple years of earnings per share. So a really famous one is Shiller, Robert Shiller. You can actually look him up. You can Google him. Robert Shiller. You can get his data. I want to actually show this to you. So I did a search on Robert Shiller data. You just do the online data. So he gives his data away for free. So you can click on that. And you notice here it is right here, the CAPE ratio. You can click on that. And you can bring it into Excel once it all loads. And he's actually doing essentially a price to 10 years of earnings. So it's an interesting ratio. It's for free. He goes back. It's amazing. He goes back to 1871. How he gets back to 1871, I don't know. But here's the actual data. So he brings in the earnings of the S&P 500. The S&P, he says the S&P 500 was 4.44 back then. It's 3,300 today. He's got the dividends. He's got the 10-year treasury. He has all this kind of stuff. And you look at what he's doing is he's taking, wow, that's a really high CAPE ratio. He's taking the current value of the S&P and dividing it by 10 years worth of earnings, but he's adjusting those earnings for inflation. If you remember, PE ratios are high when interest rates are low, and PE ratios are low and interest rates are high. But if you take inflation out and adjust it, that somewhat neutralizes that. So you really can compare these ratios over time. So if you look at the actual plot, the blue line is the CAPE ratio. The higher the blue line, the more expensive stocks are. Now it's interesting, 1929, that was right before the major stock crash, before the Great Depression. We are essentially back at that level again. That's 32.56 and we're at 31.60. You can see the stock market sold off a lot for COVID and it's come back. 2000 with the dot-com, boy, I remember making a presentation in 2000 and boy, I was pushing for us to hedge our portfolio and I couldn't get the CEO on board, but boy, I showed not the S&P 500, I actually shows NASDAQ and how expensive it was, and it was pretty ridiculous, but I couldn't get anybody to go with me on it. I was pretty nervous about it because I was taught in school that markets are efficient, there are no bubbles, so I actually admit that, I've never called a bubble before, but this one sure does look like one. Then you see the big correction in 2000, then you see the 2008, and right here was the first time in like decades that Robert Shiller said stocks were cheap during the 2008-2009 crisis. They've come back really strong. Even the COVID sell-off was pretty significant, but we've come back from that pretty quickly. So stocks are very actually, I think I said they don't look that expensive adjusted for inflation, but they actually, for interest rates, they actually are very, very expensive according to Kate. This is another way of looking at it. He also does interest rates. With interest rates, the higher the interest rate, the cheaper bonds are, and the lower it is, the more expensive. And so the point you get with this chart, which is really unusual, is that both stocks and bonds at the same time are both unusually expensive relative to their history. But free information, free data to be able to share and that you can use. And I love his data because, boy, it's easy to get. Now, if you can't get his data up to date, he's getting this data from a place I highly recommend that you go check out. It's www.standardandpoors.com. And that's actually his source for this information. And if you go there and if you go to indices and then search on earnings, Standard & Poor's will give you this information. And you can easily tie it back. S&P does it quarterly, and if you look at his data, you notice that he's taking the S&P numbers and he's spreading it to the other months. So he wants monthly data, but he's getting all this information for Standard & Poor's. Standard & Poor's is a great white website. Most of their stuff, all of this stuff, is free. They did for a while require you to actually register, but they don't require that anymore. So you can just jump on and use all of their data. So there's other ratios. Hopefully you understand what to use. So Robert Shiller, let me get to the last one. So Robert Shiller is using price and multiple year earnings per share. He's adjusting the earnings per share for inflation to try to make it so you can compare a PE ratio of one period to a PE ratio of another period. And the last one is EV, the sales, because sales before interest rates, interest expense, use EV. So there's your ratios that are possible. On the exam, I'm going to give you some ratios. I might give you price to EBIT. I might give you price to sales. I might do enterprise value to book value. You've got to tell me which ratios are incorrect and why. And it's pretty simple. If it's price, the denominator should be after interest expense. If it's EV, the denominator should be before interest expense. That's all you've got to explain. So price to EBITDA you kick out. Why? Because price is only for stockholders. EBIT is for interest expense, so it's stockholders and bondholders, so you shouldn't do price to EBIT. It should only be EV, enterprise value, to EBIT. So let's talk about which ratio to use for which industry. So that's pretty critical to understand. So I'm going to break them up into three types of industries. There's those that use earnings-based relatives like PE ratios, EV to EBITDA. There's those that use book value relatives, price to book value, and those that use revenue-based relatives, so EV to revenue. So earnings-based relatives, PE ratio, EV to EBITDA, EV to EBIT, those are mainly for firms that are focused on revenue and earnings growth. These are the high growth companies like the Alphabets and Amazon and Apples. NVIDIA's. You almost always use the price to earnings, or even the most popular today is EV to EBITDA. It's probably the most used ratio, even outside of technology stocks, but the most popular ratio, especially for firms that are fast growing, EV to EBITDA. Now, book value based relatives, price to book, there's three types of industries here. The first type would be industries that have high capital requirements. So they have a lot of book value. Utilities, manufacturing, they have a lot of property, plant, and equipment. So there are firms, and you think about Intel. Intel is a tech company, but Intel is a tech company with high capital requirements. I might actually use a price to book value to look at Intel rather than the EV to EBITDA. It might make more sense because they're a heavy high capital requirements firm. But high capital requirements, those are firms you want to look at price to book. Cyclical commodity-based companies like energy and materials, price to book works well. Why? Well, because when oil prices are high, oil companies look cheap. And when oil prices are low, oil companies look expensive. And so the price to earnings is not a good measure. They may look cheap, but they look cheap because oil prices are really high. And if oil prices come down, you're going to really overpay for that stock. And so by using a price to book, you're essentially spreading out those earnings, those oil prices over many years, and you're getting a less skewed analysis. Same thing with materials like steel companies and any company that their earnings are very sensitive to an underlying price of some commodity. And then the last group that use price to book are industries focused on return on invested capital. All your financial companies, banks, insurance companies, you almost always use price to book for banks and insurance companies. Then on your revenue base, so EV to revenue, enterprise value to revenue, you're looking for industries that are focused on margin, so retail. And EV to revenue is almost always the ratio. When I put it into models and have the model tell me what ratio is the best to use, retail almost always goes 100% of the time to EV to revenue. It just makes a lot of sense for that industry. So if you're doing Kroger's or Walmart or Kohl's or Target or Tiffany's, you're probably going to use EV to revenue. So what can you use relative value analysis for? Well, you can use it, what we do in the investment society, for screening for stocks. So we bring in a lot of data for fundamentals and risk on stocks. We then run a regression against that versus the valuation of the stocks, and we're trying to find stocks that are rich or cheap relative to those underlying valuations. And I'll show you one of those if we have time today. This might have to go into the next class, so I might have to push the examples into the next class, next session. You can use this to value bonds. There's no reason why you can't bring in, you might bring in the spreads, or you might bring in, anything related to fundamentals and risk. It's very similar type of stuff. So it's possible. I've never seen anyone actually do that, but it certainly is possible. Bonds do have a price to earnings. It's essentially the price of the bond to its coupon. If you think about the yield, you use the yield when you price the bond. If you just flip that, do the inverse of it, that's essentially the bond's PE ratio. That's why treasuries, you can think about treasuries right now have an unusually high PE ratio. You take the price of treasuries and divide it by the very low interest rates, you get a very high PE ratio for bonds right now. So right now, bonds and stocks both have high PE ratios. You can use it to value non-publicly traded companies. So when UTSA sold its investment business to Victory Capital, I'm sure the way they valued it was looking at the price to book of competing companies, public companies, and that's how they decided with Victory Capital how much to sell that business to them for. I actually did the analysis on that, and you wouldn't use price to book on that case. You'd probably use enterprise value to assets under management. And doing that analysis, I felt like UTSA probably could have gotten more for that business. It's a really high quality book of business, a very sticky business. The customers stay, they don't tend to move around a lot. There's a lot of growth opportunities there. So I think UTSA probably couldn't have gotten a better price, but who knows? I didn't see their analysis. It creates a great benchmarks for a company, public or private. So you can look and do an analysis to see what is the stock market looking at, and how does our company line up versus all these ratios. And if CEO of companies, especially a public company, is trying to ask, well, how can I get my stock price higher? Well, then yeah, all you have to do here is just look at these ratios and figure out where is the market focus. So, oh, they're focused on gross margin. Well, let's get our gross margins higher. That'll get our stock price higher. And that gets to the last thing, which I'm really talking about. What is the stock market focused on right now? When you bring in all these factors, you run a regression. What gives you the highest R squared to explain the PE ratios, the EV, the EBITDAs for your industry? So yeah, it's a pretty powerful stuff. So let me explain in words what the Investment Society does, and then I encourage you, before you graduate, that you need to do this. You don't have to join the Investment Society to do it. It's the easiest way to do it, because then you have a 45-minute session each week, and we just walk you through it. But we also have YouTube videos where you can teach yourself how to do it. So once that Bloomberg Lab gets opened up again, I strongly encourage you to go, email me, get the videos, and go down and try it yourself, because it's something really powerful to have on your resume and in your toolkit when you graduate. But essentially what we do is we go to Bloomberg, we bring in all the companies in an industry. Could be 100, 200. We might even bring in all the consumer staple companies, so it could be 200, 300 companies. We bring in all the data we can find on them for fundamentals. It can be their gross margin, their EBITDA margin, their asset turnover, everything we can think of. We have risk factors. What's their credit quality? What's their beta? What's the volatility of their earnings? What's their debt to equity or debt to EBITDA? We bring those in, and then we bring in some relative value, like EV to EBITDA. And then what we tell the model to do is take all of these factors and regress them in a way that we can explain why the stock market is valuing these companies the way they are. And we're hoping to get R-squareds in the 80s, 80% or higher. We can't always do that. Sometimes it's only 70%. But it gives us some sense. And sometimes what we have to do is you have to break an industry up. So if you do all tech stocks, you'll get a really bad model. But if you pull the semiconductor stocks out, you'll get a much better model. If you break it up. So companies are valued very differently depending on the industry. So I want to stop it here because we're going pretty close to an hour here. And so what I want to do is just whet your appetite for that. And in the next session, I will show you some of the models we built in the Investment Society, so you can see what skills you could actually build before you graduate. And that's what this last slide is saying. I'm going to show you, we actually use ranking models. I'm going to show you both. I think I'll show you both a regression analysis and a ranking model. And I don't know if I'll show you all of these examples. I definitely won't show you the P&C insurance one. I'll show you a couple of these examples just so you can see how it actually works in practice. It's really not overly complicated, but it looks complicated, so that's why it's impressive on a resume.